Welcome back. You're watching Crystal Ball. I've been in conversation with Timothy Moore of Goldman Sachs. You spoke about India possibly being at the cusp of an upcycle. Could it be as pronounced and as strong a cycle as the 2003-2007 period, or are starting valuations not quite as attractive? I mean, in those 4 years, the market went up 7 times. Do you see the cycle being as pronounced as that from an equity returns point of view?
So, just addressing the valuation side of things and to give your viewers a sense of context or to remind them, India in the last 15 years has traded from a very low level at the beginning of the sort of real re-rating period when it was down at 8 to 10 times, and then we had a clear re-rating in the mid-2000s, and we crested at well over 20 times forward consensus earnings estimates in 2007, just the beginning of 2008. So the PE in January of 2008, which was the previous bull market peak, was around 22, or depends on which estimate you look at, 22, 24 times. Now, the average over this period has been about 15 times earnings, which is roughly where we are right now. We're a bit above. We're about 15.8 times earnings right now, so maybe about 0.4 standard deviations above that 15-year average. So, we're a little bit above the 15-year mean, but basically, we feel quite comfortable where the valuation is right now, particularly given the fact that we think we're at the beginning of a cyclical upturn, as I mentioned earlier, both in the economy and in earnings. So our forecasts for the Nifty, which is about 8,300, that basically is just assuming valuations in line with the 15-year average. Now, you could argue that in this environment, we could be a little bit more generous with valuations. So we don't feel that that forecast puts sort of everything in the shop window, so to speak. There could still be some upside to that if the market got a little bit more enthusiastic. So I guess the net of what I'm saying is that we feel that valuations, even though they've expanded in the last few months, are still at reasonable levels, particularly or critically if we are indeed getting the sort of fundamental improvement that appears to be taking place.
How would you play it in India, Tim, right now? Because the kind of sectors which have moved in the last few months is very different from what has led the market up in the last 2 or 3 years. High-quality defensive names like IT, pharma have been consistently, and consumers have been underperforming. Do you see this pro-cyclical, anti-defensive trade strengthening, or would you want to take a different view in playing the India game right now?
No, we've put our cards very clearly on the table, and that is that we have basically a view which is pro-domestic cyclicals. So we very much like IT in terms of the quality of the companies, broadly speaking, and so forth. But as you correctly said, they had a very, very strong move earlier on. They benefited from the depreciation in the Indian rupee, and they were pretty well held from a positioning standpoint. So understandably, there's been some rotation away from those names back towards the names which would be, or the parts of the market, which would be broader and more direct beneficiaries of the changes that we've seen take place, which are obviously this expected shift in policy by the incoming administration. Now, that, as you correctly said, that trade or that view has been working well in the last few months, but we think there still is further to go. So to be specific, the so-called entry point for the investment now is not as good as it was 2 months ago, but we still think there's further to go in that view. And to be specific, we have a group of what we call reform beneficiary stocks, and this group was trading about 11 times earnings. It currently is trading about 13 times, and so it still appears inexpensive relative to the market average of about 15 to 16 times. And if you look at relative performance of this type of stocks, for about 2 years they dramatically underperformed. Just recently they've begun to outperform, but relative to the 2-year view, we're still at the early stages of what we think would be a more sort of secular uptrend in the performance of these sort of stocks. So the bottom line here for us is that we still think there's further to go in terms of this domestic cyclical outperformance and re-rating.
Within cyclicals, what would be your most favored pockets? I mean, would it be industrials? Would it be autos and auto ancillaries? Would it be oil and gas? Would it be metals? I mean, what would you put the highest weightages to?
So again, we've been very clear in this, and our overweight sectors are industrials and energy. We certainly like those areas of the market very much. We also like the banks, by the way. Autos, we're more selective, so we're market weight on autos. Doesn't mean we don't like them, but we'd be a little bit more partialized and a little bit more specific. And indeed, we think one of the ways to engage in the market is not necessarily to blindly go in terms of industry sectors, but it also may be to take what you might call some of a vector or a thematic approach, which is to look across sectors and try to pick out the stocks that are more specific beneficiaries of some of the policy changes that we are expecting to more fully manifest. So that might be another sort of kind of a vector within the market that you might want to explore. And then within the market, the sort of underweight areas for us right now would be what we call the expensive defensive, some of the consumer staple stocks. Very, very good companies. We like them, but they're well-owned, and their valuation ratios tend to be significantly above those of the market and also significantly above where their own averages tend to be. And then the healthcare stocks also, they've done well. We think that they're probably a bit off the boil right now. So again, it's not that we would be, disliking them fundamentally, but we just think from a positioning and a valuation perspective that there may be better parts of the market to engage in than those parts.
What about mid-caps, Tim? Because they've started performing after a long time. Last 1 month has belonged to them. Do you see a lot of interest in global investors to pick out or cherry-pick Indian mid-caps now?
Well, it's a great question, and this is actually something we've been flagging for a while, that there was a very significant valuation difference between the large caps, which of course are more liquid, and then the mid caps. Now, a quick historical reminder on this is the reason why we've had that very significant valuation difference is that people made a very large amount of money in mid caps, and they were very much the flavor of the day during the bull market. And then we had a significant downturn, and people lost really a very, very large amount of money, because what can happen with Indian mid-caps is the liquidity, the daily trading value can decline very precipitously. So people had probably gotten a little bit too long or too overexposed to those stocks, and then when the liquidity dried up and people tried to sell, they exacerbated the downturn, and that led to some very significant losses on people's portfolios. Of course, what that did is it left some scars on people's backs, metaphorically speaking, and that meant people were really shying away from that part of the market. So with the overall upward momentum regaining in India, people are beginning to take a little bit more risk, and they're going down the capitalization spectrum, and they're beginning to stick their toes back into the waters as far as the mid-caps go. Now, this is a normal feature of stock markets. It's not unique to India, but it clearly is taking place in India right now. And we would expect some further broadening of ownership to take place within the quality mid-cap space. So bottom line here is we think there is some good value for people who have the ability to take that extra liquidity risk. And we think that there is some very good opportunity for stock picking in this part of the market.
What's happened in the last few months